So in this session we are going to talk about valuation. Please remember the disclaimer, read it if you haven't done it yet. So if we come back to the framework we are following, if we remember within the analysis we had 4 different parts: profitability, growth, management, and valuation. So in this session we are going to talk about valuation. So this is a great quote from Joel Greenblatt, in which he says that the secret of investing is figuring out the value of something and then pay a lot less. This is the main concept of value investing. The value is different to the market price, and we need to assess or to estimate the value in order to know if a security is undervalued or overvalued. Of course, we want to buy something that is undervalued, and whenever it is overvalued, we want to sell it. So, first of all, when we talk about price, we are talking about the market price at which we can buy the stock at a given moment. And when we talk about value, we are talking about intrinsic value. So, if we want to calculate the value of a stock, and this is, for instance, based on the free cash flow, it could be calculated based on different metrics, but in this case we are going to use the free cash flow, that is the cash flow available after business operations, and thus the free cash flow that is available for shareholders. So if we take into account the free cash flows in the past, the history, we are not going to have an estimation of the value, because what we need to take into account are the cash flows in the future. In this case, the free cash flow in the future. And for this, we need to make the forecast. But the history, the free cash flows in the past, and how the business and how the company behaved in the past, is going to give us some hints, is going to tell us the story or the symptoms. And with the analysis, this is going to allow us to analyze the causes and key factors in order to analyze the forecast. So we have to remember that only the future determines the value, but the past can be a good hint, a good analysis in order to know what can happen in the future. We have different methods for estimating the value of a stock or of a company. One of them, the main one, is the discounted cash flows. This is if we talk about the future cash flows, and we also take into account that at some point we are not going to be able to calculate, or we don't want to calculate the cash flows until the infinity, until the end of the time. So what we can do is to estimate a residual value that is based on the constant growth in the future after some years, that we estimate is going to be constant, just forgetting the residual value. So with this, the inputs we need for estimating the value based on discounted cash flows are the forecasted cash flows, of course, the residual growth rate. So we need to know after some years what is going to be the growth rate that is going to be constant. Normally, what is going to happen is that if it is a company that is growing at this moment, is going to achieve one moment, is going to reach a moment in which no more exceptional growth is going to be available because of competitors, because of the total addressable market. So we can assume that it's going to come back to the standard growth rate, or to the GDP growth rate. So from this point onwards, we can assume the residual value based on this. We need to assess, we need to input in this method the discount factor. So it is not the same a cash flow that we are going to receive today or tomorrow than a cash flow that we are going to receive in 5 years. So we need to take into account that the money is not the same right now that in the future, and it depends in the interest rates, because if it is in the future, we need to take into account that if we had this money today, we could gain an interest on them, but also in the risk. As much risk we expect of a cash flow, as much as less certain it is in the future, we should apply a higher discount factor, so at the present day this value would be less than in the future. And also we need to know the non-operating assets value of this company. So apart from the business cash flows, it could be that this company has an excess of cash or some assets that are not employed in the business, but which at the end they can add some value to the assets. So with this, knowing the discount, what we are going to do is, apart from the non-operating assets, we are going to discount these different cash flows until the present moment, until today, and adding them up to the non-operating assets, we can have the intrinsic value. When we talk about non-operating assets, we have to take into account as well the debt. Okay, so the debt is going to remove some value from the cash flows that we are discounting from the future. On the other hand, we could calculate the value based on multiples. So imagine that we have some current cash flow, the last year cash flow, that will be this one, and we have future cash flow as well as residual value is one. When we calculate or when we estimate the value of a company based on multiples, we have to take as input the last or the next year cash flow, a multiple that we are going to see how we can calculate it or how we can estimate it, and the non-operating assets value that the same as in the discounted cash flow, it is something that we already have, so we don't need to discount it from the future. So the multiple is going to depend on the growth that we estimate for the future of this company and on the risk of how risky or how certain or uncertain these cash flows are. As these cash flows are more uncertain, the multiple should be lower. So it is the opposite as with the discount factor. And the same with growth. When the growth is expected to be high, so we expect more value, the multiple can be higher because we are taking, and this is because we are taking the cash flow of the last year or of the next year, and if the growth is going to be high, we expect that is going to add more value than the current cash flow. So multiplying this multiple by the cash flow, in this case we are using the free cash flows, but we could use the earnings or we could use other metrics. We are going to get the business value. Adding the non-operating assets, we can get the intrinsic value. So here we see we have from one side the business value of the operations, and on the other hand the non-operating assets that must be added in order to get the intrinsic value of this company. So what is best, the discount cash flows or the multiples for calculating the intrinsic value of a company? So if we see the pros and cons of the discounted cash flow in multiples method, first of all, the pros from the discounted cash flows is that it's going to be more precise. Only, of course, if forecast cash flows are reliable, because if we enter cash flows that are very uncertain, we can fall in the trap of thinking that we have a precise estimated value, but it is as precise, it only can be as precise as the forecasted cash flows. The concept that it implies more work than the multiples, because we have to calculate the different forecasted cash flows and to discount them back to the current value. Of course, we can do this with a spreadsheet. It's not so much work, but at least it's not so immediate as when we talk with multiples, that we can just make a multiplication and we get a rough estimation of the value. The pros for multiples is that it's easy to calculate, as we are saying, and the wrong is that when we have volatile cash flows, that they are not going to grow in the approximate constant value, we are going to be very wrong. The thing is that with discounted cash flow, we have to take into account that whenever it's very uncertain in the future, we also are not going to be able to get a good estimation of these cash flows. So we have to think if it really makes sense, if it really it is going to give us some value to calculate, to estimate these cash flows, or with a multiple we can get a similar rough estimation, so we don't need that.